Ever wondered how financial companies manage to raise capital? There are several methods they utilize, each with its unique characteristics and requirements. Firstly, there's equity issuance. This is when a company issues new shares of stock, either through initial public offerings known as IPOs or secondary offerings. By selling these ownership stakes, the company can generate the necessary capital. Secondly, there's debt financing. In this case, companies issue bonds, notes, or other debt securities. Investors lend money to the company with the expectation of receiving interest over time. Thirdly, financial companies often use their retained earnings as a source of capital. These are the profits that the company decides to reinvest back into the business rather than distribute as dividends. It's a crucial resource for expansion or meeting regulatory requirements. Private equity is another method. Here, private equity investors provide capital in exchange for ownership stakes. This method is especially common for startups and firms that are in the phase of expansion. Subordinated debt is a slightly more complex method. Financial institutions issue this type of debt, which is repaid after all other debt obligations. It's a way to generate capital while maintaining senior debt. Preferred stock is another option. By issuing preferred shares, financial companies attract investors who receive dividends before common shareholders. However, these investors typically don't have voting rights. Asset sales also provide a means of raising capital. This involves selling non-core assets such as subsidiaries, real estate, or non-performing loans. Securitization is a method where financial assets such as loans are bundled into securities and sold to investors. This strategy transfers risk and provides capital. Hybrid instruments are securities that combine elements of debt and equity, offering financial firms flexibility in raising capital. Government assistance is another potential source of capital, particularly during financial crises. This can take the form of capital injections or guarantees to stabilize financial institutions. Finally, there's crowdfunding and peer-to-peer lending. Some fintech companies use these platforms to raise capital directly from retail investors. The choice of method depends on various factors, including the company's financial condition, regulatory constraints, market conditions, and specific capital needs. It's common for financial institutions to use a combination of these methods to diversify their sources of capital and manage risk. In summary, financial companies have a wide range of methods at their disposal to raise capital, from equity issuance and debt financing to retained earnings and private equity. Each method has its pros and cons. The choice of method depends on various internal and external factors, and often a combination of methods is used to manage risk and meet specific capital needs.